Following the tremendous volatility in the markets this past week, along with Trump's guessing game on tariffs, foreign investors are retreating from U.S. debt, causing a significant drop in the bond market and spiking yields. Now, the U.S. Treasuries, once a cornerstone of financial stability, are losing their safe haven status amid rising yields and global uncertainty. For decades, U.S. Treasuries were considered the bedrock of the global financial system. Today, however, confidence in the world's largest economy is under intense pressure as the $29 trillion Treasury market experiences a sharp and unsettling sell-off. Prices on government bonds have plunged, and ING analysts captured the market's mood perfectly, saying the Sell America trade is currently dominating the market. Treasuries are not behaving as a safe haven. Now, yields on the 10-year Treasury jumped to 4.5%, and the 30-year bond rose above 5%, marking the biggest three-day surge since 1982. Now, because Treasury yields move inversely to bond prices, this jump signals a major decline in investor appetite for U.S. debt. Columbia economic historian Adam Tooze summed it up, saying, "This is the script for a truly existential crisis, and the ripple effect is already being felt. Rising yields increase borrowing costs across the globe. Businesses and households are now facing more expensive mortgages and loans, and the gap between the 2-year and the 10-year yields is widening to its largest point since 2022, which is a sure sign of economic uncertainty." Now, this sudden turmoil has upended the traditional role of U.S. bonds as a refuge during economic stress, bringing in a new and unsettling perspective for investors looking for safety. If the age-old tried and true safe haven is no longer reliable for conservative investors, where do they turn? Now, stocks have also taken a major hit, with the S&P teetering into a bear market, down more than 20% from its recent highs. And the spark for the sell-off in bonds and stocks came from rising tariffs and the U.S. entangling itself into a full-blown trade war. China retaliated against U.S. tariffs of 104% with their own tariff of 84%, and that initial jolt set off a fire sale further fueled by growing fears of recession, inflation, and of course stagflation. And JP Morgan Asset Management declared the global safe haven status of Treasuries is in question. Former U.S. Treasury Secretary Lawrence Summers echoed that concern, saying the broader sell-off signaled a generalized aversion to U.S. assets in the financial global markets. Now, Summers also warned that the potential for a serious financial crisis is here. We saw investors make a mad dash for cash while the Dow tumbled over 4,500 points, and as a result, money market funds have hit a record high through April 2nd of this year. We saw a very similar situation play out in 2020 when panicked investors also dumped bonds, and they triggered a liquidity crunch so severe that the Federal Reserve actually had to step in and stabilize those markets. Now, the most recent bond auctions are drawing the least interest we've seen in years, signaling that demand for U.S. debt is waning and the cost of insuring against a U.S. default is actually climbing fairly dramatically. Markets are now concerned that China and other countries could dump U.S. Treasuries as a retaliation tool against our tariffs. It's worth noting that global institutional investors are already very heavily invested in U.S. assets, and thanks to the dollar's reserve status and America's traditional reputation as a safe harbor, many funds have become overweight in U.S. debt. These same investors now have plenty to offload in this market, where U.S. debt is surpassing $36 trillion and reaching over 120% of GDP, and of course becoming less appetizing. Now, China alone holds approximately $760 billion in U.S. Treasuries, and they've been reducing their holdings as they pursue de-dollarization. If China accelerates these sales as a response to our tariffs, it could send U.S. interest rates soaring and spark an even bigger stock market sell-off, depreciate the dollar, and of course trigger a major wave of inflation here in the US. Another factor behind the bond market disruption that we're seeing is the so-called basis trade. Now, in normal climates, hedge funds are consistent buyers of Treasury bonds. They use them to hedge against futures exposures. And although the profit on those trades for them is minuscule, it's nearly risk-free. And so what happens is firms will use high leverage for entry, typically as much as 50 to 100 times. But those trades are now unraveling. Hedge funds are no longer buying, and in many cases, they're actively selling off their Treasury positions, and that's adding more pressure to an already volatile market. One thing is clear though, the global economy is undergoing a dramatic transformation. Long-held assumptions are being challenged, bonds are losing their safe haven status just when uncertainty is reaching new highs. So where can Americans turn to protect their wealth? Now, increasingly, that answer is gold and precious metals. Governments, institutions, and individuals are setting record demand for gold as a shield against market volatility. So if you're concerned about what you're seeing in the economy, if you're worried about the overall positioning of the US dollar in the world, and you're looking for a way to protect your investments, I'm Mackay Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals into your portfolios can give you the hedge that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.